Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday the 11th of April 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Chris Jakubowski, Director of Institutional FX Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek.
Chris, hello. How are you?
Yeah, very well, thank you.
Good.
Just keeping my head above water. How about yourself?
Yeah, it's been a dramatic week for sure. Lots of client requests and different aspects being analysed and focused on. So yeah, a lot going on.
It's difficult to try and find a way to look at it, because everyone's just trying to figure out how Trump, or what Trump's actual idea is here with all these different we don't know what they are. Is he trying to get better trade deals? Is he trying to get more jobs back in the US? Is he trying to fill the coffers with money? It's like, where do you start? And then he's back and forth. So anyway, it's been difficult certainly to speak to clients and stuff, but let's jump in, I guess, with that. And I think he was denying that it would ever happen, but we have a 90-day pause. Weaker equities, weaker dollar, and probably the straw that broke the camel's back was the bond market, and it normally is. He was probably given a lot of pressure when we saw weaker treasuries and higher yields as well. He's got himself into a bit of a pickle here, it seems. What do you see in the next, how's your head fixed for the next, I guess, 90 days, right? Or is more going to change in that time? I mean, it feels like we just need the dust to settle and we need to figure out what's going on. But from your perspective, what have you been telling clients? Because it's hard to get actually an outlook for yourself. And
yeah, well, I was presenting to clients in Amsterdam on Wednesday, so I came home and by Thursday morning I was like, wow. So it's
start again.
It's extremely difficult, obviously, to forecast and predict the whims of an individual. I'm sure he's being influenced, but he seems to be influenced by a relatively small number of what I would call hardcore trade policy individuals. Stephen Mirren, Howard Lutnick, and Jamison Greer. And, it's a small group must be influencing him. And to go to your point at the beginning in terms of what's the ultimate objective, to be honest, it flips and varies from day to day. But, in terms of, I do think tax cuts are a really important aspect of what Trump wants to do. And in that sense, I think certainly his idea of tariffs filling the coffers to finance the tax cut plans, I think is definitely part of it. And that's why I think, some level of tariffs, I think, are going to persist for a considerable period of time, perhaps through the entire administration. But I think when you look at the Treasury market, as you've mentioned, the 30-year is through the roof. And, incredibly, just looking at the 30-year yield today, since around the middle of February, the 30-year yield, which obviously dropped but has now rebounded, but over the period since the middle of February until now, the 30-year is now up 10 basis points. And over the same period, the S&P 500 is down 13%. So, and, we've had this very clear period of triple selling. And we've done some analysis on that in terms of picking out periods when you've had the scale of triple selling that we've had this week. And, statistically, from a quant's perspective, it points to dollar depreciation over a 2 and 3 month period. So what we've got to come back to is, okay, it's clear what's driven all of this. It's Trump's mad policies that he announced with this ridiculous formula that gave us these figures for global tariff rates. And he's pulled back on the vast majority of those, but like nobody in their wildest dreams would have predicted 145% tariff on China. So as we stand today, like you mentioned 90 days, I don't think we have that long. I think something has to happen before that, or else things are going to unravel pretty quickly. And it's very clear that we're entering a crisis of confidence in terms of
in terms of him as well, because it's a question which we can go to afterwards as well. But on the 145%, which you touched on, I was reading as well, and I have sympathy with this proposition. Is it becomes meaningless? What they go next? They go 200%. I mean, it essentially already has frozen trade in the sense that it makes it completely impossible to really use those tariffs to continue trade between the two nations. So they're basically putting the brakes on trading, right? And there's small business and businesses have been, they've been speaking to across the areas. Like suddenly, tax tariff bills go from 20% a year to 300%, and that's real economy stuff. This is stuff where it hits the electorate more than the people that are making. He had that mistake as well, that he said, yes, one of my good friends here made 200 billion. These people aren't getting affected. It's the people that voted him in, right? Then this fallacy of thinking that we're going to suddenly get a rebirth of the Rust Belt, the blue collar jobs will come back, people will have more money. The only thing I can see at the minute is the immediate or the most the quickest effects that's going to come through is inflation through to the individuals and the people that buy the cheaper products that come from China, and the real inflation is going to come through and hit the consumer purse immediately. And he's just going to surely he's going to lose favor with the electorate in rather dazzling fashion. It seems unhinged. I mean, to your point,
Yeah, it's certainly going to hit probably. Not in next month's data, but the month after, based on looking at the tariffs that were implemented on washing machines in 2018. It takes a month or two before you see it physically in the CPI data.
Yeah.
But it's still coming, and it's going to come before the Fed meeting in June, which is fully priced for a 25 basis point cut. And you've got to question the prospects of that when the curve is steepening and the long end is selling off so dramatically, and you get to a point where you've had this big jump in month-on-month inflation, and the Fed can't really have a sense of the broader reverberations of that in terms of inflation expectations and broader product prices. And of course, domestic producers are going to be lifting the prices as well because they can see the opportunity. So it would be risky to cut. Now, obviously, if the labour market unravels in the next couple of NFPs before the June meeting, well then, but it's not a done deal, and the market is still very much priced for it. So I think there could be disappointment there, which could obviously reinforce the asset price sell-off that we're in the midst of as well. So,
do they not discount it a little bit? You think the Fed, in looking at it, because I was thinking about it like from a supply side shock, right? It's not so much demand led, so it's not like the inflation's coming from consumer or the economy being overheated in the US. It's largely coming from these supply side shocks, which are coming from tariffs, which are increasing prices. So arguably, that isn't actually a reaction function of monetary policy in the US as internally, and because of the the real economic effects that we've spoken about, like the consumer purse going down and people potentially losing their jobs. Do you think that they would still go, okay, we're arguably stagflationary territory, right? Where the economy slows down, inflation is going up. Do you think that won't tip them in favor? I mean, you said you did note that if the employment data comes off, then they might, but.
I think we're in a different world post-COVID, post the largest global inflation shock since the late 1970s, early 80s. And as we were walking up here, we saw the Michigan consumer expectations figures, and short term and the 5 to 10 year both jumped. And what's happening, and what I think is one of the reasons hurting the dollar is real yields are coming down pretty sharpish, because break evens are certainly at the short end of the curve are still very sticky. They're not coming down. Nominal yields have come down. Therefore, real yields are coming down, which is a real negative for the dollar. But now I think we've even gone beyond yields. And if you look at nominal yield spreads, there's been a breakdown, and the dollar has now extended much weaker than what's implied by rate spreads, which is an indication of a loss of confidence.
Yeah.
And those kind of normal day-to-day variables that drive FX are basically out the window now.
Yeah.
And it's a crisis of confidence, and it's down to positioning and stress and covering losses. And that means, euro dollar 120, which was laughable a week ago, is now, it's very feasible. And that's why I think something has to happen. So there's a tariff shift by the Trump administration. There's something they shift on their tax cut policies, which, I don't think it's a coincidence that the bill was passed in the House this week. And the figures in it is just, it's ridiculous that they're considering adding over 5 trillion
but then
to US debt.
But on the best examples, don't they raise 2 trillion from the tariffs? And that's assuming that the trade continues at the same level with those tariffs. So it's still unfunded, isn't it?
Yeah, but all aspects of it is not credible. Also, they're talking, although it's not in the bill, Mike Johnson has said 1.5 trillion of spending cuts is doable. And I just don't think it is. So there's a lot of question marks, and ultimately investors will see what they're doing as deficit financed spending cuts or tax cuts. And it's just going to reinforce the loss of confidence. So they either shift on that, they shift on tariffs. I think the idea of Fed support is very questionable. We're at QT 5 billion per month. Okay, they could end QT, but we're talking trillions about these budget deficits over a 10-year period. So I think ending QT is not going to do anything. Would they go into restarting QE? I think in this environment, no chance. The only way the Fed comes in a meaningful way is if there's also a policy shift. There's no point in the Fed trying to do something if what's triggered the crisis is Trump's policies without changing Trump's policies.
Yes.
So that's not going to happen either. And then this kind of other element that's in the background all the time, and I'm getting asked questions about it all the time, is Steve Mirren's piece that he wrote about restructuring the whole global trading framework and the need for a weaker dollar and a kind of a new accord forcing China and Japan into perpetual bond purchases and then lowering rates and allowing their currencies to strengthen versus the US dollar to get a weaker dollar. And again, now Steve Mirren he's now Trump's head of his Council of Economic Advisors. Okay, we know from his written piece that's his view. He says it's not part of administration policy. But nonetheless, when you see the people in the administration, you see what they're doing with tariffs, investors are going to conclude they want a weaker dollar. And they may need to come out and try and temper that or make comments that are very explicit that they're not looking at an accord to weaken the dollar and they're not trying to weaken the dollar. But that I think is also reinforcing the negative sentiment that we have at the moment, because it is there in the background. What does the Trump administration want? And investors think they want a weaker dollar.
Yeah, and what do you, putting the US to the side then, and the other party that's involved is obviously China. They don't seem to want to back down about this. It's going to take two to party on this, two to tango as such. So even if they want a tariff shift, are China going to play ball? Are China going to give enough to Trump? Because Trump's going to need to keep face in front of his electorate, right? Are they going to give him enough to be able to do that tariff shift, which I think is probably the most likely? I think he'll have to shift on their unfunded tax spending as well. But also, are they gonna play ball? Because currently he's only having meetings with other foreign counterparts, as opposed to he's obviously trying to talk to other nations to try and sort out new trading agreements and sidelining the US, much like the US is trying to do by talking, to the likes of Vietnam and the rest of it and trying to broker deals there. But,
Yeah. Well, let's not forget also that, saving face is ingrained in Chinese culture.
True. Yeah.
So I just don't see any chance that China are going to back down, given it's very clear that the US initiated this trade war that ultimately we now have between the US and China. So I think it would have to come from the US side. Now, of course, China have retaliated today, lifting it from 84% to 125%. So for Trump to back down anytime over the next couple of days seems quite unlikely as well. But having said all of that, we're talking about Trump. And if there's one thing Trump is, it's unpredictable. So they did it for the rest of the world in terms of a 90-day suspension. It just wouldn't surprise me. And ultimately, it's going to be the markets that force Trump into action. The markets or Congress. And of course, Congress and the markets is linked as well. But, the Republicans in Congress, they've got to step up. They've got to use their power to try and stop what Trump is doing. Now, the worse the markets get, the more encouraged the Republicans in Congress will be to tackle the White House. But as you can hear from what I'm saying, all avenues are through the markets getting worse than where they are today.
Yeah.
So it may mean next week things get worse in order to force Trump to maybe postpone the Chinese tariff for 90 days as well.
Because he doesn't have ages either with the midterms in 2 years, and if he wants to continue to have all the the three wings of control that he does at the minute, he needs to make sure that this is a car crash.
Yeah, and as you know, Chris, we've spoken about it before. Our view, even before all of this happened, was that the US was entering a cyclical slowdown, and that's why we had dollar depreciation in the second half of the year. And by the way, our euro dollar forecast at the end of the year was 114, which was much more aggressive than the rest of the market. And of course, we've already hit that. But of course, now that cyclical slowdown is going to be reinforced by what's happening in equities and the elevated uncertainty in relation to Trump. So in a way, damage is done, and the prospects of recession are considerably higher. And unless there's a rapid turnaround and an improvement, I think that's where we're heading. And in that sense, maybe investors, in terms of FX, they're seeing that further out. They're becoming more convinced on a recession hitting, and that's why they're kind of bailing out and going into, again, I've said to you, G10 performance standard top three currencies in terms of risk aversion: Swiss franc, Japanese yen, and euro. And certainly from a yen and euro perspective, they're the biggest, most accessible bond markets to go to if you don't want to go into US treasuries. And the spreads that we've seen move this week, there's been a big outperformance, much bigger outperformance than usual for core German bonds, basically, and JGBs. We've seen the US spread over those 10 years widen out dramatically this week. So it does look like, from the price action, that we are seeing a shift in investors into those bond markets. And their currencies are performing as you'd expect.
Okay, and let's move on to Japan now, specifically the BOJ. Our friends in rates, MUFG, have taken out their hike call for the year out to Jan 26. Now, it feels like the market has priced that as well. What are your thoughts here? Do you think that there are potentials? There's been better communications between Japan, and there's been some positive mood music around that. Do you think that the economy will fare better than some of the other nations, and they'll get away with it? And what are your rate expectations? And then we did touch on the yen, but being a safe haven. But what are your thoughts there as well?
I think first of all, when you're in this kind of market turmoil, the yen influence was always going to be safe haven flows rather than the kind of shifts in monetary expectations in Japan. And of course, BOJ's rate expectations by the end of the year have come down markedly. Interestingly, though, Ueda spoke this week, and he could have easily given an explicit message that they were moving to the sidelines because of all the turmoil, and that would have shifted expectations even more. But he didn't. So, I do wonder if they're being a little bit careful about not wanting to elicit any kind of sharp reversal in the yen. Now, again, I still think the broader market conditions are more important, but nonetheless, if those stabilized and the message from the BOJ was we're on the sidelines, there's a risk then the yen could weaken back quite notably. And of course, in terms of the trade negotiations with the US, Scott Bessent's messages in the past have indicated that he believes BOJ monetary policy is at the root of yen depreciation, and if they believe there's a currency misalignment and the yen starts to weaken after BOJ communications, it wouldn't help. So I think that they're probably being careful over the short term to try and improve the backdrop for a quick trade negotiation and a deal being done. So that makes sense to me. In terms of BOJ monetary policy, yeah, like we haven't formally changed our view, which was July. I certainly think July is going to be very difficult unless there's a dramatic change in the next kind of couple of weeks. So we'll probably be pulling back our view as well. And but yeah, the BOJ, the JGB market is it's over 1,000 trillion yen, which is about $8.5 trillion. It's a huge market. And of course, for the first time in nearly any of our careers, when we go into a crisis, we now have a scenario where, in actual fact, going into Japan, you've got yield as well as the other advantages. So, I think the Swiss franc is outperforming the yen, which I can understand based on if there was a sudden rebound in US rates, investors might be thinking the yen would weaken. So maybe the Swiss franc is a cleaner safe haven choice at the moment. But of course, the SNB could start to voice disapproval. They could start intervening. They could cut rates to negative. There's things the SNB could do as well. But I get it over the short term why the franc is outperforming the yen. But they're still the two currencies of choice.
Two safe havens, yeah. Okay, great. Thanks very much, Derek. I won't take any more of your time. I probably have to the weekly to finish off, so I'll let you rush off and do that. So yeah, it just leaves me to say thank you very much for your time.
Indeed, and thanks, Chris, for the chat.
Cheers. Thanks very much.
Thanks.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.